Finance and development are two closely intertwined concepts that they play a crucial role in shaping the economical, social, and political landscape of a country. Finance refer to a management of money and other finance assets, while development refer to the process of improving the economic and social well-being of a society. In this essay, we will explore our relationship between finance and development and how two concepts are interlinked. The role of finance in development. Finance play a crucial role in the development of any economy. It provides the necessary resources for investment, which is essential for economic growth and development. The availability of finance allow business and individual to invest in new projects and expand their operations. This leads to the creation of new jobs, increased productivity, and higher incomes, all of which contribute to economic development. Furthermore, finance also enable individual and business to save and invest their money, which help to mobilize resources within an economy. This allow to the efficient allocation of resources as money is directed toward project and initiative. They are likely to generate the highest returns. Another critical role of finance in development is its ability to promote financial inclusion. Financial inclusion refers to the provision of financial service to individual and business who have traditionally been excluded from formal financial system. This includes services such as bank account, credit, and insurance. By promoting finance inclusion, finance can help to reduce poverty and inequality by providing access to financial service that can help individual and business to improve their financial well-being. The role of development in finance development also play a crucial role in finance sector. Economic development leads to an increase in income and wealth, which in turn leads to higher level of saving and investment. This creates a virtuous cycle which increase investment leads to further economic growth, which generate more income and saving, and so on. Furthermore, development all also leads to certain of new financial instrument and service. As economy grow and become more complex, there is a greater need for financial innovation to meet the changing needs of business and individual. For example, the development of any financial instrument such as derivative and securitization has enabled business to manage their financial risk more effectively and access new source of funding. The relationship between finance and development is complex and independent. On the other hand, finance is essential for economic development as it provides the necessary sources for its investment and facilitate the efficient allocation of resources. On the other hand, economic development is prerequisite for the development of financial sector as it leads to an increase in income and wealth, which in turn leads to higher level of saving investment. However, the relationship between finance and development is not always straightforward. In some cases, the growth of financial sector can outstrip the growth of the real economy, leading to financial instability and economic crisis. This was the case during the global financial crisis of 2008, where the growth of the financial sector led to an unsustainable build-up of debt and financial instability. Furthermore, the development of financial sector can also lead to increased inequality. This is because the benefit of financial development are often concentrated in the hands of a few individuals and business who are able to access and benefit from financial service and products that are not available to the wider population. This can lead to a widening gap between the rich and the poor, which can have negative social and economic consequences. Policy implication. Given the complex relationship between finance and development, it is essential that policymakers adopt a balanced and nuanced approach of promoting financial development and economic growth. This requires a range of policy intervention, including promoting financial inclusion. Policymakers should prioritize policies that promote financial inclusion, such as the provision of basic financial service to the unbanked population and the promotion of financial literacy. Regulating in addition to financial institution, financial policy also play a crucial role in promoting economic growth and development. Financial policy can help to create an enabling environment for financial institutions to operate and can also address market failure and other barrier to financial development. One important financial policy for development is the regulation of financial institutions. Effective regulation can help to ensure the safety and soundness of financial institutions, protect consumer from fraud and abuse, and promote market stability in many developing countries. However, regulatory framework may be weak or effective, which can lead to financial instability and undermine confidence in the financial system. Another important financial policy of development is the promotion of financial literacy and education. Many people in developing countries lack basic financial knowledge and skill which can make it difficult for them to make informed financial decisions. Financial education program can help to address this issue by providing people with the knowledge and skill they need to manage their finance effectively. Tax policy can also play a role in promoting development by providing incentive for investment and saving. In many developing countries, tax system may be poorly designed or implemented, which can discourage investment and hinder economic growth. By implementing tax policy that provide incentive for investment and saving, governments can help to promote economic development and reduce poverty. Finally, financial policy can also address market policies failure and other barriers to financial development. For example, in many developing countries, credit markets may be incomplete or segmented, which can make it difficult for SMEs and other under-reserved population to access credit. Financial policies such as credit guaranteed